Kicking off the local market, looks like we've seen quite a nice recovery, but just wondering whether these highs will actually last for the rest of the year. Let's bring in Bogdan, Chief Investment Officer at Blackmore Capital, who joins us live from our Melbourne studio. Marcus, thank you so much for joining us on the show this morning. What do you think? I mean, we've really, well, since that flush out that we saw sort of right before Christmas, on Christmas Eve, we've managed to see a very nice recovery. I think it's more than 10% now since those lows. Do you think this can continue? What's your expectation sort of going forward from here? It's been a nice start to 2019, certainly.
Yes, it has. Good morning, and thank you for having me on. We went into the December quarter with historically large cash weightings of 15 to 20% across our portfolios, principally driven by the high valuations. And the downturn and the drawdown in the market has been significant over the last couple of months, and so has the recovery. So we allocated some of that cash in December to some of our names already held in the portfolio, such things as Brambles, Cleanaway and Woolworths. And we also added a couple of new names into the portfolio, namely Commonwealth Bank and Ramsay. Earnings per share growth is moderating. Valuations have come back somewhat. I mean, at the beginning of calendar 2018, valuations, the PER was around 16 times. That got down to about 14 times at the end of December, which is around their long-term average. But with moderating earnings per share growth and valuations being modestly priced, we expect it to be slow going. But again, it's very much idiosyncratic to certain sectors and companies that we've allocated our capital to.
And is it more so growth stocks? I mean, are you looking at value plays as well? I know I was talking with my guest host here, David Sokulski, a little bit earlier actually, and he was sort of saying they've got a mix of growth, value, income stocks. How is your portfolio and your fund kind of positioned, certainly in the late part of this investment cycle?
Sure. No, I agree with David. I think a blended approach is absolutely appropriate, where you have got a mix of growth, value, and quality, and what we call quality at a reasonable price. So at one end of the spectrum, we've got a group of staple companies in essential industries where they've got a strong reoccurring nature in their earnings. We're also focused on those companies with strong balance sheets that have got the ability to return capital back to shareholders, and you've seen that with BHP and companies going into the reporting season, the ability to bring back surplus franking credits to investors. And then with this sell down, we are looking at value as well, or companies that have rebased their earnings somewhat, and you're seeing that in Commonwealth Bank, you're seeing that in things like Ramsay Healthcare, and that's why we've modestly built up positions in those two companies in the December quarter.
You mentioned you added CBA to the portfolio. It's been an outperformer in terms of the banks in recent weeks. Is that the only bank you hold, or is there a reason why you chose CBA over the other banks?
Yes, we do hold ANZ. We hold an income portfolio, and we do hold ANZ in it. But over the last couple of years, we have been very much underweight the four banks. In our blended portfolio, we've bought in Commonwealth Bank. It's our only retail bank in that portfolio, and principally for a range of reasons that we've chosen CBA over the others. One is its capital position is well placed to meet APRA's requirements in 2020. We believe that the dividend and the dividend payout ratio is sustainable, and that is important, especially if you compare that with something like NAB. And we believe that the underlying franchise, despite all of the bad news, despite the rise in cost structures there, support a view that we are building a modest position in CBA, certainly underweight its index weighting, but we have made a start there.
Marcus, we're looking ahead to reporting season. It's so crucial, I guess, to see how companies report their earnings and, how it justifies, I guess, valuations and share price levels and so forth. What are you looking for? Obviously, we're in quite a crucial part now as well, so-called confession season, pre-announcements. But what are you looking for ahead of earnings season kicking off in February?
Yes, well, pre-announcements has given us some insight, especially into the consumer stocks and how difficult that has been. And if you just look at the slowdown in sales in Kmart. So more insights around the consumer and also the outlook for those consumer type companies, particularly interested in Wesfarmers and the outlook for Bunnings going forward, given how interlinked they are to the housing sector and how they've retained such high levels of sale growth historically and very, very high margins. On the industrial and the more cyclical stocks, we're very much interested in the cost structures, the impact of energy prices there. One of the things that we are looking for is the ability of capital returns, and with those companies with strong balance sheets and excess franking credits. We've seen that in BHP. We're looking at Caltex. We're looking at Woolworths in particular for companies that may have the ability to bring back capital to shareholders. And then CBA is the only one of the 4 of the retail banks reporting, and so an update of what they're seeing around provisioning, around credit growth, and also the cost side of that business as well.
All right, fantastic. Look, Marcus, unfortunately we're out of time, so we'll wrap it up there, but really appreciate your thoughts with us, and crucial time over the next few weeks. Thank you so much. I'm sure we'll speak to you soon.
Thank you very much. Cheers.
Marcus Bogdan, Chief Investment Officer at Blackmore Capital, joining us there.